Hello, Kevin Bullock here. Welcome to Accounting 101, Origins and Ethics. You know, it's really interesting. The double entry accounting system, the way that we have it today with the T accounts and the debits and the credits and journal entries and ledgers and what have you, closing entries, this has only been around for about 500 years or so, 600 years. The Italian merchants of the 1500s were the ones that started developing this system, and that's when it proliferated and really started being used more frequently. And in fact, an Italian monk by the name of Luca Pacioli is credited with documenting this double entry accounting system. Now, he didn't administer it, he didn't invent it, he didn't develop it, he was credited with documenting it. Now, why do we need accounting? Okay, bottom line, we need accounting to be able to maximize the resources of our business. We maximize our resources by helping to measure the performance of those resources. We measure them by producing financial statements. That's the byproduct of our accounting system. A very strong accounting system will have very good financial reporting. And the financial reports will allow decision makers to make better decisions regarding the business, whether making decisions about revenues or cutting expenses, going after target markets, or streamlining things. Maybe there's a division that isn't performing and they got to decide whether to cut bait or to keep fishing. Now, accounting can be defined as a systematic way to measure available resources in a business. Again, we kind of focus on the resources. We measure that. But we also control those resources with a good accounting system. Good internal controls will help to prevent the occurrence of fraud, which fraud has two components to it. There's two types of fraud. There's the misappropriation of assets, which is good old-fashioned stealing of money, or computer equipment or office supplies or things like that. There's also fraudulent financial reporting. And this can be very, very damaging. We will talk about a few companies where there were billions of dollars, millions of dollars of damages in covering up and misreporting billions of dollars there. How can we use accounting? Who uses accounting? Okay, in a business, you have two major types of users, and it kind of sounds no-brainerish, but really these are two major categories. We have internal users, which may be a CFO or a boss if it's a sole proprietor, or a board of directors if it's a nonprofit. Depending on the corporate structure, you may have board of directors or managers or department heads. It all depends on how your business is organized or your clients are organized. And those internal decision makers will help. The good financial statement will help them make good financial decisions. Now, there are external users as well. You may have a bank, for example, that's considering lending the business money to maybe expand their capital, or expand their infrastructure, get ready to expand and to increase the capacity of the business. Or it may be that the proceeds are just going to fund operations, which is a sign of a not very healthy company, and a lot of times banks don't issue those loans to help fund operations, but you have to really sell that. But anyway, another type of external user we have is an investor. An investor might be considering whether to put his capital, because he's looking for a return on his investment, and he might be looking to evaluate whether this company can provide the best return for him, or maybe an acceptable rate of return. Okay, who uses accounting? Everybody uses accounting. Just you use accounting. You may not even realize it, but you produce financial statements. Have you ever thought about that? Now, of course, businesses, we've talked about them. They have to have good accounting practices and policies and procedures. They have to have a good accounting system to produce those reports. But you produce a financial statement every year, whether you realize it or not. In America, we have to file tax returns. Now, when you realize these are financial statements, and one good indicator that they are is when you go to refinance or to purchase a house, they ask you for 2 years of tax returns. Why? Because that is the closest thing you have to a financial statement. You're putting your revenues together, your income, the deductible expenses in the context of taxable income, and then based on that taxable income, you determine your tax rate, and your how much your tax is, and then you based on that, you determine how much you paid in or didn't pay in, and then you calculate whether you get a refund or not. Well, really what they're looking for is they're looking at the components of income and expenses, and so that's your financial statement. Corporations and businesses, of course, are required to have good systems, and we've talked about that already. But you know, there are other fields. As an accountant, you studying other fields can help develop better financial statements for your clients or your company or your employer. And different disciplines like math and business, there's so many different facets of business. There's marketing, management, operations, flow analysis. There are so many different fields, and even different fields like arts and humanities and things like that can help you contribute to a good financial system, a good analytical system, and help evaluate the financial system to help your decision makers make better decisions. Ethics time, right? A high standard of ethics and operating by ethical principles is vital for a good accounting system. We talked about fraud. Now, fraudulent financial reporting, as I said, misappropriation of assets can be damaging because when money walks out the door, or supplies walk out the door, or capital walks out the door, it's hard to maintain operations because you need to maximize those resources. But fraudulent financial reporting can be even more damaging. So let's look at Enron for a second. Enron was a publicly traded energy trading company, and they had illegal partnerships on the side, and those would be reported. Their partnerships were legal. They engaged in illegal activities. So then they just flowed into the income statements, income or loss from partnerships, and on the balance sheet it was just investment in partnerships as another asset, other investments. The auditing firm gave this a clean opinion. Oh, I will tell you one more thing. The Enron used these partnerships to hide over $1 billion in assets, or loans, sorry, $1 billion in loans. The auditing firm, $10 million audit engagement, gave them a clean opinion on this, but they had $50 million in consulting fees, so obviously they had a conflict of interest. Well, it was a whistleblower internal. It was an employee with high ethical standards that blew the whistle, and the dominoes all fell, and the Enron is no longer with us. The auditing firm that issued the financial statements, the clean opinion, is no longer with us. They got the death penalty, and there are new regulations in place, and we'll talk about that in just a second. So the other one we want to talk about is WorldCom. Now, WorldCom is a great example. They had to restate their earnings because they had issued $3.1 billion to the founding family, and they did not report it correctly in the financial statements. They tried to hide it, or at least it looks like they tried to hide it. So the auditing firm, this was where the auditing firm caught it, made them restate their earnings, which again, $3.1 billion in loans to related party would have made a lot of investors make different decisions as to whether to invest in here. So class action lawsuit, millions of investor dollars lost, and WorldCom is no longer with us as well. Okay, so what we got out of the companies, there are other companies, many other examples like that, but what we got out of that was the Sarbanes-Oxley Act. Now, Senator Sarbanes and Senator Oxley sponsored this bill. Almost made that a Q. The Sarbanes-Oxley Act. The net result of this was that it increased the policing of the financial reporting systems, and it strives to create stronger internal controls and more attention to those internal controls to reduce the instances of fraud and misconduct in relation to fraudulent financial reporting. The byproduct of this act was 100,000 accounting jobs were created in publicly traded companies, and the cost of audits tripled within the first 3 years of the Sarbanes-Oxley Act being passed and used. So as you can see, ethical principles are very important to maintain and to have in an accounting system. Well, thank you for joining me. As you can see, we talked about the history. We talked about the reasons that we have and that we need accounting. We talked about the purposes and who uses accounting, and then we talked about ethics and the need for ethical principles. So I've had a good time. I'll talk to you soon. Thanks a lot. Take care.